In this video, I'd like to talk about the yield curve. Before we go into the details, let's review what yield is. Yield is the return on a bond purchased in the secondary market. It is mathematically the following. Yield is equal to the coupon of the bond, which is the annualized coupon, divided by the price that you pay for that bond. So for example, if I were to pay, let's say, $100 for a bond that pays a $10 annual coupon, then I would have a yield of 10%. That's what I care about because I just bought a piece of paper called a bond for $100 and I'm going to get $10 a year. That's a 10% return. Note that if I'm able to get a better deal on that same bond, let's say I don't pay $100 but I pay $50, well, then the yield that I'm actually getting is 10 over 50, which is 20%. Note that when the price of the bond went down, the yield went up. And that's because coupons are fixed. They're in the contract. So this doesn't change, but the price could change based on market forces. Also, we could say, well, what if the price were to go way up? Let's say it were to go up to 200. Well, I'm paying $200 to get $10 a year. My yield is now 5%. Notice in this case, the price went up and the yield went down. And that's a common truism that we've talked about. It's the yield-price relationship. If the price of a bond goes up, then that means that the yield must go down. And if the price were to go down for the bond, then the yield must go up. Well, we always accept it as true, but now you know why. Okay? Prices change in markets. Coupons don't. Thus, yields adjust with prices inversely. All right, now what would affect the price of the bond and therefore yields? Well, demand and supply. If you have an increase in demand, for example, for bonds, let's say demand for bonds goes up, well, that means people want more bonds. And that's going to lead to an increase in prices, which would lead to yields going down. How does this happen? Well, a lot of people all over the world want to demand treasury bonds. They're the hottest bond in the world because they're considered the safest bond. I mean, that's the debt of the federal government of the US, so it's perceived as being very credible. And so if foreigners like the Chinese and the Japanese and Canadians and Europeans, if they like to buy US Treasury bonds, then that increases the demand for them. And it actually lowers the yield on US Treasury bonds. And that, in turn, makes it pretty cheap for our government to borrow money. Now, another thing that could influence the demand for government bonds would be the Fed, monetary policy. Remember, they like to intervene in these bond markets in order to change interest rates. Well, they actually do that by changing the demand for treasuries. So if they go in and they start buying up more treasuries, then that'll lower yields and make it cheaper for the government to borrow money. Now, you say, well, how does that lower interest rates for the whole economy? I mean, whether China buys treasuries and creates lower yields, or the Fed buys treasuries and creates lower yields, how does that translate into me getting a lower credit card rate? It does this because as treasuries bring about greater demand and lower yields, other types of loans like auto loans and business loans and mortgages on houses and credit card loans, they actually become more attractive relative to treasuries, which causes an increase in demand for those loans, which drives down the yield for them. It's like ripples in a pond. You know, if the treasuries are witnessing an increase in demand and lower yields, then we would expect the same thing to happen for other types of loans. Okay, so that illustrates the relationship between yields and prices. Now let's jump into the relationship between yields and maturity, which is actually what we're going to build here with our yield curves. First off, what is maturity? Well, maturity is the length of time for the loan. So if you have a treasury that is issued with a maturity of 10 years, then that means that the government is going to borrow money today and it's going to have to pay that money back 10 years from now. And every year in between, it'll pay interest. If the maturity on the government treasury is 30 years, then that means that 30 years from now, the government will have to pay that money back. And in between, every year, it'll pay the interest, the coupon payment. Normally, the relationship between maturity and yield is positive. Something like this. Normally. What that means is the longer the maturity, the higher the yield. Well, that should make sense because if you're going to lend money to the federal government and they're going to pay you back 30 years from now, you're going to expect to get a higher interest rate per year than if they're going to pay you back, say, 1 year from now. One of the major factors that creates this normal curve is inflation expectations. People generally expect inflation to be a bigger problem over longer periods than over shorter periods. I mean, if you're going to lend a friend $1,000 for a year, very short maturity, you might not even consider inflation. But if you're going to lend them money, $1,000, and get paid back 30 years from now, you're going to have to charge them a lot more because you know that inflation is going to erode the value of what you lend them over time. So you're going to get paid back less purchasing power than what you give them. And that's why you add this inflation premium to the loan, which is why the longer the maturity, the more of a concern inflation becomes and the higher the yield that is charged in normal times. So what do we see in abnormal times? Well, one of the interesting things about this yield curve, and the reason we talk about it, is it has an amazing degree of success in predicting recessions. In fact, your book details this out a little bit, but most of the recessions, in fact, I think all of the recessions that occurred from 1969 to 2007, they were predicted by the yield curve. And that change that tells us we're headed for a recession is called inversion. It's going from a normal curve, which is upward sloping, to an inverted curve. Okay. When we see this movement from a normal curve to a flattening, we have a sense that a recession might be looming. And then when we get an inversion, we see the recession in full play. The reason is because of inflation expectations. When we go into a recession, people expect deflation in the future, not inflation, which means that they actually are going to have a higher yield on short-term maturity loans than on the longer term, because they're going to be getting back money in the future that will have more purchasing power due to the lower prices. So it's actually a very simple model if you think about it. The positive yield curve denotes that we expect inflation in the future and are charging a premium for greater maturity loans to capture that inflation. And then the inverted curve tells us that we have the expectation of deflation in the future, a recession, which tells us we're willing to take lower interest rates on longer maturity loans because of the lower prices in the future. So that's the way we want to interpret the yield curve. Now let's take a look at some of the links from our report in Blackboard. So this is information that's regular. So you can pull this site up anytime you want. It'll give you the most up-to-date information. In other words, it's not coming out like weekly or anything like that. It's like stock markets, it's ongoing. Notice here we have government treasury yields, 3-month maturity, 6, 12, 2-year, 5-year, 10-year, and 30-year. By the way, when we have maturities for treasuries that are up to a year, we call them treasury bills. When we have maturities of 2, 5, or 10 years, we call them treasury notes. And then when we have treasuries that have a maturity of 30 years, we call it a treasury bond. Just terminology. So the federal government issues bills, notes, and bonds. Now, I want you to look at the most current information, and this is from today. What you're going to see is today, as of 4:59 p.m. Eastern Daylight Time, the yield on a 3-month government treasury was 0.12. Now, that's annualized, right? So almost nothing. You lend money for the government for 3 months, you almost get zero return. 6-month, a little higher. 12-month, a little higher. Look at how low these are, though. My God. So that's 0.15%. That's 15/100%. Now you know why you get such low interest rates on your bank accounts. Because what banks often do is when they take your money in a checking account or a savings account, they know that they've got to have a lot of that money available in the event you want it back. Those are highly liquid assets. You can go into your savings account anytime and get that money out. And so what they do is they invest this money into very short-term government instruments. And if they're getting these kind of low returns, then they're not going to be able to pay you much of a return on your savings or checking account. Gets a little better when we get to the 5-year and the 10-year, but notice the theme here. We are going from a short maturity to a longer maturity, and we're getting higher amounts of annual yields, which is consistent with a positive, that is the normal yield curve. Okay. However, it is important to note that even though this is positive, it is not a steep curve by any means. And this probably has to do with recent events that are suggesting we're going to be going into a recession officially in the near future, which means the yield curve, even though it's normal right now, it's not steep and may actually be flattening and could invert in the near future. Okay, now here's another link that I posted on Blackboard, and this one actually shows with real information as of today, April 15th, 2020. This is the Dow or the S&P 500. Don't worry about that. But here's the yield curve. So it shows for very short-term yields, and then you see it's positive. Okay. So we would expect this yield curve to, be steeper if there was expectations of inflation in the future. It might look something like this, right? Or could be quite steep if we're expecting a lot of economic activity in the future and inflation, but it's not steep. It's flatter, and it's probably going to flatten more as we start to expect less and less inflation and also less economic activity. Okay, let's take a look at this again, and I wanted to mention that there is this thing called the spread for the normal curve. The spread is the difference between the 30-year bond yield, which is 1.27 here, and the 3-month bond yield or bill yield, which is 0.12. So if we take 1.27 and subtract 0.12, we get a spread of 1.15. That is a very narrow spread. In normal times, we would expect about 2.5 percentage point spread. If we had more than that, then we would consider the curve to be steep, okay? And if we have less than that, then it could be a harbinger of a recession to come, which, no surprise, we might be headed for one if we're not already in one now. All right, that's it. If you have questions, let me know. Thanks.